One. A very good day to you all, and welcome to the Wall Street Blockchain Alliance's Call the Lawyers Podcast, episode number 5. My very special guest, legal working group friend, Mr. Joel Telpner of Sullivan Worcester. Joel, how are you, sir?
I'm doing great. So I am in Windham, New York, which is in the northern edge of the Catskills, and my 4.5-month-old puppy thought it would be a really good idea to chase a bear.
Oh my God.
And fortunately, the bear didn't realize that it was much bigger than the puppy, and it ran away. But I'm not sure if there are any blockchain solutions that you've come across yet that can deal with how to train a young puppy. But if you have one, let me know.
I'm there with you, and it's funny. I have so my wife and I have a rescue dog. You ready for it? He's approaching 17.
Wow, good for you.
And yeah, and I feel like we have to train him all over again. So if I find that solution, we'll be in touch. I promise.
Thank you.
So Joel, one of the things we try to do in these kind of informal podcasts is really talk about salient topics from a crypto and blockchain perspective, as well as that intersection in law and legislation and regulation. And in the past 4 podcasts, we spent a lot of time with colleagues of ours on the legal working group talking about Telegram. I don't want to talk about that yet. We could talk about that a little bit. But I know you've been doing a lot of substantive work in the realm of central bank digital currencies.
Right.
And I think if you throw a rock somewhere in the blockchain world, someone's saying CBDCs, let's level set. Define for us and the audience, which will be the wider membership here, what do we mean when we say central bank digital currency? And what are those kind of top level benefits that people need to be aware of when we talk about them?
Sure. So I think it is actually really good to level set because currency today, in many respects, or at least transactions in currency, are already digital. You use your credit card or you use your smartphone. I mean, especially since the pandemic started, I probably have gone 3 months without having actual cash in my pocket at all.
Yep.
So we transact already digitally, but what we're talking about is actually going to the next level. Because when you transact with a credit card or with your smartphone, at some point, somewhere in that chain, somebody's in effect converting that back into real cash, into paper, or they have a right to ultimately receive cash or paper. So what we're talking about is going to almost a logical conclusion where you take that currency that exists right now in paper form or in coin form and say, why do we need to have it in that form? Why can't we just have it exist in a digital format altogether? So it's taking the US dollar, for example, and if we were to throw away or burn all the paper currency tomorrow and melt all the coins tomorrow and just said from now on, we're going to issue dollars in a digital format, that is at a very high level what we're talking about. And so when we talk about central bank digital currencies, we typically mean that a central bank, in the case of the US, for example, the Fed, on behalf of the government continues to print money, so to speak, as it always has, but it's doing it in a digital format. And while it doesn't have to, it very well may utilize a distributed ledger or blockchain technology as the methodology of getting that digital currency out into the marketplace. One other thing I think I would probably throw out, and then I'll shut up for a minute, but is that when we're talking about central bank digital currencies, they often fall into 2 categories. One is wholesale and the other retail. Wholesale would be a central bank digital currency that's intended to primarily be used for interbank type of transactions. And so again, right now between the Fed, for example, and commercial banks, there are entries that are computerized already. So banks have deposits with the Fed, which are all electronically recorded. And so we would again be taking that to the next step and using a digital currency for interbank type of payments. A retail central bank digital currency is really intended to create something that would come down to the level of the individual citizen or individual consumer. So you and I would be able to directly transact in a central bank digital currency. And so it would be, again, some type of tokenized digital currency that would likely use blockchain technology that would allow us to be able to directly have access to dollars or whatever currency we're talking about in a new digitized form without having to put paper or coins in our pockets.
So let's peel that back a little bit. We've had conversations similarly in the past, and I come out of financial services. So when we look at that wholesale level,
right,
let's think about banks approaching the discount window of the Fed. And for the colleagues
right,
who are too young to know what you and I are talking about when we say discount window, they can look that up. Or, Fed funds interbank borrowings, the overnight windows that are available. I want to argue that one of the benefits there is cost effectiveness and efficiency. But is
Right.
that just it? And the reason I ask that is because a lot of what we hear is from the old liners, well, we're digital already. I don't
Right.
see the blockchain overlay and why.
No, so that's a great question because that also gets into why. And I think that the motivation or the drivers probably for retail versus wholesale are quite different. So on the wholesale level, I tend to agree with you that at the end of the day, the way banks transact among themselves or the way banks transact with central banks is already fairly far along in a computerized or digitized world. So the benefits of going to this next step are only if we create further efficiencies, further cost reductions and savings, and are able to, in effect, take payment pipelines that exist now and make them better. And so the reason why people are looking at this on the wholesale side is that if you look at the existing payment pipelines, like the SWIFT system and so on, they're fairly antiquated, actually. They haven't been updated for many years. And so right now we're kind of at a turning point or tipping point where we could start to really try to put in capital to improve those systems that are starting to creak. Because it actually takes a while, especially when you're going from one currency to another, to settle those transactions, surprisingly, in our modern world. And so if a digital blockchain solution can do that more efficiently, then we'll see that happen. Mm-hmm. Otherwise, we'll see these existing pipeline systems, innovate themselves. And if that's a better solution, we'll see that happen. So on the wholesale level, I think it's just really a question of can we do something more efficient, cut costs, and maybe reduce the settlement time, especially when we're going from one currency to another.
Yeah. So one last point on it, the delta for that wholesale world, particularly going from one currency to another, as you and I know, is where a lot of legacy organizations make their business.
Yeah.
So what's that look like in the context of the conversations around CBDCs? And there really is I don't want to call it lip service, Joel, but there are a lot of public conversations around global banks and money center banks participating in the blockchain ecosystem. But right. Some of what we're talking about really starts to cut at specific margins for them. What are your thoughts about that?
Well, so two things. First, a general answer, which is, you and I have had this conversation many times, which is that blockchain technologies in general can have a very disruptive impact where they can disintermediate a lot of traditional intermediaries in financial transactions. Yeah. And that's a big element of blockchain technology. And so the same is true here. It has the potential of eliminating intermediaries, especially those intermediaries that may have not kept up technologically with the times. However, I have no connection with the Bank of England, so they're not a client in any way, shape, or form, but I'm giving them a plug because they came out with a paper that talks about central bank digital currencies. And I think it's one of the best papers in the market because it talks about the public-private partnership that would be required to get digital currencies into the marketplace. And so it talks about a number of roles that are actually would still be required of private parties that would team up with central banks in order to create the ecosystem as to how you get a digital currency out in the marketplace, especially when we talk about the retail side. So while we might see one generation of intermediaries getting disintermediated, I think there are going to be a number of new players that are required to participate in this ecosystem in order to make it work.
Right. Understood. No, I appreciate that, Joel. And so sticking with that central bank theme, I feel like the past 3-4 months, maybe since the beginning of the year, every sovereign on the planet, every sovereign nation said, we're getting involved in CBDC. Right. You mentioned BOE. Obviously in the States, and we can talk about it in a little bit, the congressional testimony around some of this. Singapore, I think Dubai also, and most prominently China.
Right.
And so there is also, and I want to call it a misperception, particularly those not involved in law or banking, that this is the United States screaming, we got to catch up, China's leaving us behind. And you've been having a lot of conversations across a bunch of different ecosystems. How true is that political economy aspect of the conversation around CBDCs?
So I think there are probably 3 drivers that are moving this forward. And so you mentioned China. I think that probably is a factor where there are certainly people that are sounding an alarm bell saying, for example, the United States, look at what China's doing. If we don't do the same thing, we're going to be left behind.
Yeah.
And you can find plenty of articles saying that China, once it introduces a central bank digital currency, it will become the new world reserve currency. Now, my personal view is that that's not going to happen, because I think that even if China is way ahead of the United States in introducing a digital currency, there's still a huge trust issue. Again, my own personal view, among the motivators for China to introduce a digital currency is that it allows them to better monitor payment activities, transactions, who is doing what with respect to their currency, how, where the money is going, who's paying whom. And so China looks at this, I think, among other things, as a way to monitor various types of financial activities. And as long as that is true, or even perceived to be true, I think that, China may impose and require people within China to use that currency, but to get the world itself to adopt it as a new reserve currency, when there are concerns about providing that data and access to the Chinese government, I think is going to be a real limiter. But nevertheless, there are concerns that, if the United States, for example, worries about getting behind. The second driver, was the announcement now last year, by Facebook and others, about creating Libra, that's a so-called stablecoin.
Yeah.
And so, we can talk about stablecoins, but there was concern that if you looked at Facebook and all of its, billions of users, that if they created an alternative to a fiat currency, that could create systemic economic risk, but it could really take power away and control from governments, impact negatively monetary policy, and create all kinds of regulatory and other concerns. And so the notion that there could be a non-legal tender substitute that people would rather use as a means of payment made a lot of people nervous. Yeah. The third factor, though, that I think is probably among the three the most relevant, important, is especially not in developed countries like the US and China, but in smaller emerging market countries, where even before the COVID crisis, we had a situation where in a number of lesser developed countries, getting access to traditional banking is not easy. We take it for granted in places like the United States, but a lot of countries around the world, just being able to have access to a bank is very hard, either because there is literally no bank within physical proximity to where you live, yep, or the banking system is such that unless you are a wealthy individual, that bank in that country has no interest in having you as a customer, because it's not cost effective. And so you've got a huge portion of people in the world that don't have access to banks or traditional the traditional channels of the global economy. So if you can create a digital currency for your citizens, and in effect, to the extent you so choose, bypass that banking system and use smartphones and smart cards to put your currency in the hands of your citizens, all of a sudden you are economically empowering a huge portion of your population that sat on the sidelines. And so when we get into the current global pandemic crisis, where people are sheltered at home, we're not interacting with each other the way we have historically, we've seen that issue magnified even more, where how do we make sure that people still have the ability to buy goods and services, to transact, to participate in the global economy? So to me, out of all the drivers, that's the most important one that is causing countries, especially smaller ones, especially lesser developed countries all over the world, to seriously look at whether a central bank digital currency or digital currency can be a solution for empowering and creating much greater economic inclusion within their country.
And it's interesting that you raised that. We've had that conversation, not you and I, but within the legal working group and other aspects of the WSBA around the unbanked and underbanked.
Right.
I tend to really agree with you, particularly on the nations that are much smaller or less infrastructure. This might truly be that opportunity. And I think in the popular discussion, we're really neglecting to talk about how many trillions of dollars in potential economic activity could be initiated by the unbanked and the underbanked. That both raise.
It's got to be huge.
It's got to be huge. Yeah, huge.
And so, there's I think one of the other important factors also drives this is because, again, we're talking about, well, it doesn't have to be. Most solutions right now are looking at using some type of blockchain or distributed ledger. technology is part of it, but that means also we can embed within the digital currency using smart contracts the ability to do other things that we haven't been able to do in the past.
Right.
In other words, we can combine that with identity so that you can prove who you are. So not only are you able to have access to money, to your money, and spend it, but you can also go into a store, for example, and prove that you're over 21 if you want to buy alcohol, for example, or just to be able to prove definitively that the money is yours, it's in your account, it's not somebody else's. And so once we start to look at the way that we can create intelligent money as opposed to dumb money, we can start to much better give people access to it. And then from a regulatory standpoint, while there's still a lot of nervousness about blockchain and crypto assets and so on, over time, governments, and this is another thing driving this, are trying to realize that when we're using this technology, we actually, at the end of the day, have a much more efficient way of addressing things like AML and know your customer and money laundering issues than we do when people transact using, suitcases full of cash.
Right. And so, this is a generational conversation. And what I mean by that is the example for me is look at something like a Robinhood.
Yeah.
I'm an old E-Trade kind of guy and all of that stuff. And yes, I do have but my niece and 16 or younger, they know this stuff implicitly. So now to your argument, your point, what happens when money becomes that level of engagement with people, and what's the economic activity associated with that?
I totally agree. And look, I mean, I don't want to brush over, there are a lot of challenges that still have to be implemented. In other words, we can't have systems where, like other crypto assets, we have to do this in a way that people don't need to understand what things like digital wallets are. And we need to be able to protect against losing, for example, private keys. And so this really has to be something that is as simple as, if you have access to a smartphone and you know how to turn on a phone, or you have access to a smart card with an embedded chip, that's all you need to be able to transact. And people are working on that right now. We're getting to those solutions, but that kind of what I would call hardware aspect also has to marry the blockchain and software aspect for this to really be able to work. And so we're getting there, but we still have a ways to go.
Agreed. So I know that you and the Sullivan team and some colleagues have done quite a bit of work, and I want to think back to the Financial Stability Board report. I think you worked with the Chamber or some other organizations. Can you tell us a little bit about the report itself, and what, if you're comfortable, we're happy to make a link available on the podcast after this.
Sure. So, right now there are various global organizations that are looking both at central bank digital currencies and stable coins. And so one of the things that we're looking at right now is how to respond to a Financial Stability Board consultative paper on stable coins, what they are, how do we define them, how should they potentially be regulated. And so a lot of times when we talk about central bank digital currencies, as a corollary, we also talk about stable coins. And I already mentioned Libra. And the first thing to say about stable coins is that it's not a legal concept. There is no agreed upon definition of what a stable coin is. And so part of what various organizations like the FSB are trying to do is say, can we even agree on what we mean by a stable coin? And so generally, and it doesn't mean that this is a globally accepted general definition, but generally people are talking about a category of crypto assets that have some type of methodology or mechanism that is built in as part of that is intended to try to minimize or eliminate price fluctuation or price volatility. And so the way people think about stablecoins is they take a crypto asset and they maybe link it to or tie it to a fiat currency. So one example is something that's backed by underlying dollars. And so it doesn't mean that the price of that stablecoin doesn't change. It just means that it's going to change in correlation to the price fluctuation in dollars. Or you create a stable coin that's linked to or backed by some other type of asset, like a commodity like gold. Or you create a stable coin that uses some type of human intervention or algorithmic methodology to try to implement or impose a monetary policy on top of the stable coin to limit or minimize its fluctuation, or you do some combination of all the foregoing. Right. So it's a crypto asset class that's intended to have some element of price stability involved that may be used as a store of value. In other words, it may be a way people can park investments into a stable coin as a means of liquidity or as a means of stability as they go back and forth into other crypto assets, or maybe as Facebook had hoped, it becomes a substitute means of exchange or means of payment that people will use to pay for their coffee in a Starbucks or to buy a car or whatever in lieu of using a fiat currency. And so when we're talking about stable coins, we're talking about a crypto asset that, unlike central bank digital currency, is not legal tender.
Right.
It's not issued by a government, so it doesn't have the full faith and backing of a government, but it may potentially be a substitute for legal tender to the extent that the market accepts it either as a stable type of investment or as a means of payment. So that's what we're talking about. And so part of the debate is there such a thing as a stable coin? If so, should we regulate them differently than we regulate other crypto assets? Or if it's a stable coin that's backed by an underlying basket of assets, should it just be regulated the way we regulate other securities? Or if it's a stable coin backed by an underlying commodity, should we just regulate it as commodity? Or if it's a stable coin that's simply linked to fiat currency, should we just regulate it like currency? So part of the debate is, do we need new regulations at all? Or do we have existing regulatory regimes that already apply? Is there some type of stable coin or activity of stable coin that could become so significant that we need to think about them from a systemic standpoint and maybe potentially impose new regulatory regime on them? And how do stable coins overall interact or relate to the parallel initiative that we just talked about with respect to central bank digital currencies? So that's what global regulators are trying to look at right now, and that's what they're thinking about.
Yeah. And I would argue, I'd be interested in your perspective on this, because in addition to the legal, obviously we have a crypto asset working group and our colleagues in banking. And in many of the discussions I've had, it almost seems that institutions are a bit more comfortable talking about engaging with and potentially allocating money to stablecoins. It seems to be an easier conversation than the conversations we were having a couple of years ago about Bitcoin, for example. Right. Put aside Paul Tudor Jones putting 2% of his wealth in Bitcoin, et cetera. Are you seeing the same thing from an institutional perspective? Is the concept of stablecoins more palatable for institutional adoption?
It's potentially. I think it is. I think they can fill a hole, though. I mean, think about let's talk about in the context, for example, of hedge funds. Hedge funds go in and out of different asset classes, and so one of the challenges is if you went to a hedge fund and say, hey, you should take a piece of your portfolio and allocate it to crypto, like to Bitcoin or Ether. One of the challenges a hedge fund would say is, all right, fine, but how do I go back and forth between like dollars or fiat? Because as well, there are a lot of people working on it. As this industry gets more mature, it'll get easier by the day, but it is still difficult to go between crypto and fiat.
That's right. So
one of the things that people looked at stablecoins doing is it becomes a way to move your money out of a volatile category of crypto. To the extent that you look at Bitcoin is interesting, but you say, well, it's still a very volatile asset class. You can go in and out of Bitcoin by going between Bitcoin and a stable coin without actually having to go all the way back into fiat. So it fills potentially a hole in how you manage your portfolio within the crypto space. It allows you to have a temporary asset class to put money into while you're waiting to redeploy it somewhere else. And it creates a substitute for potentially having to go in and out of fiat. So that's been one of the early, I think, areas where stable coins have been very attractive. A similar area is that, again, stablecoin creates an alternative of having to go from one currency to another currency, which brings into, as I said, questions of the cost of transacting, going from one currency to another, and the time it takes to often settle trades from one currency to the other. So if you can go into a stablecoin in lieu of going among currencies, it potentially creates efficiency. So we've seen that as being, I think, an early use of stablecoins that have attracted the institutional side of the market. Using stablecoins as a means of payment, I think, again, along the lines that maybe like a Facebook envisions with Libra, we haven't seen yet, because that requires, a lot of legacy world to have to interface and interact with a stablecoin that, to the extent they're going to accept that as a means of payment, and that requires a lot more retroactive, integration with the physical and retail world.
Right, right. Joel, thank you. Really appreciate that. Last thing I want to leave off with, one of the hypotheses that I personally have had, pivoting just a little bit, is I'm really hopeful about a lot of the conversations it seems that regulators are having. And we've talked about, and all of us, certainly you and your team, SEC, CFTC, OCC now recently reached out, Mr. Brooks, around kind of a notice of public response, or I'm pretty sure I'm screwing that up. So there seems to be this progressive regulator perspective in the United States. We've got to start keeping up, and that's heartening to see. And then I don't know if you saw it, but I had the opportunity to watch the Banking and Finance Committee in the United States Senate meeting, I want to say about a week ago. Did you have an opportunity to see that at all?
I read a summary of it. I didn't see it, but I did read a summary of it. To me, there is this core of a handful of legislators who get it, who are learning, and they're interacting with chambers and other associations, and that's really, really important. And there are this core of legislators who not only just don't get it, but don't seem to want to get it. And without naming names, I certainly wouldn't do that. One of the senators, I believe, raised if you're talking about the states with poor broadband, your plans are trying to disintermediate and destroy people with poor broadband. So you clearly hate the farmland states. And that's not the relevant conversation. So our argument has been this education curve for legislators around the world. Do you see the same thing? Do you see that as the biggest headwind versus regulators? Well, you've got to look. I think you've got to peel that onion at different levels. But just as an aside, it was, even though it didn't go anywhere, it was interesting to see in one of the early versions of the CARES Act that there was a concept of a digital dollar as part of that. So the fact that it even made it in a draft was interesting. But you've got at the regulatory level, what people are doing at like the SEC and CFTC, and they have constraints. People like to beat them up, but they have constraints in that at the end of the day, they can't disregard the law itself. And so there are some limiters on how far they can go because they can't disregard security laws that may have been written, back in the 1930s. That's right. But they are trying, I think, they do get beaten up unfairly. And I think they are trying in a rational, sensible way to move things forward to the extent that they feel they have regulatory discretion to do so. But, to a certain extent, it requires, action at the legislative level. And we've got a minority, small group of Congress that I think does get it. I think we've got a lot of people that unfortunately focus on the fear side. They see, again, what players like Facebook are trying to do, and they immediately think about all the potential negatives, and they don't focus, unfortunately enough, on how we can empower people in this country and how we can maintain our competitive advantage vis-a-vis other countries using this technology. And that requires, I think, a lot more education. We've got some people in the executive branch that are very much opposed to this, unfortunately. And so there is no legislative initiative coming really from that side of the government to push it forward. If you compare that to where we were when the United States was pushing the internet, the executive branch was a big proponent of internet technologies. We're not seeing that here. But within the executive branch, you've got players within Treasury, for example, and the Fed that are starting to really say, hey, we need to be looking at all of this much more seriously. And so the tide is changing a little bit. I think that organizations in what you run and WSBA is doing from an education standpoint continues to be the most critical factor, because if we do nothing else, we have to continue to dispel a lot of bad information out there that causes people, especially in Congress, to immediately be fearful of all of this. We need to continue to educate them about the opportunities, not only for people at the individual citizen level, but how as a country this is going to help the United States stay competitive. And so I'm not pessimistic, but I would say that I'm not overly optimistic either, because we've still got a lot of education to do.
There's still work to do. Joel, I could talk to you for hours, and if I haven't said that to you before,
likewise,
you're hearing it now. Let's leave it there. It's such a privilege. Thank you so much. We'll stop here. Everyone, thank you so much. We'll post this publicly and chat with you soon.
Great. Be well, be safe.
You as well.